In this video segment, we're going to talk about just some fundamentals of investing and how to really follow some of the counsel the brethren have shared with us. And so hopefully this segment will be helpful for you. So as we consider those investment fundamentals, first as you begin, I encourage you to have an emergency fund before you start investing. That may be 3 to 6 months worth of your income. And it's actually, I would look more at your expenses. And so if you have unemployment, the reality is all of a sudden your travel, vacation, a lot of other things may come immediately out of the budget. So I would look at your life-sustaining expenses and make sure that you have at least 3 to 6 months worth of those expenses set aside, and then begin looking at the investing. So one of those questions that we look at when investing: are you going to outlive your money? Is your money going to outlive you? As you start to ask that question, if it's uncomfortable, hopefully there's something we can learn about today in helping that process. Once again, I often ask the question of how much money do I need to retire? Well, the principle behind that is, do you have enough money coming in from other sources right now that you don't have to go to work? If the answer is no, then more investment needs to take place. Be patient, follow a process, and let that happen over time. The goal isn't to actually sell every last thing that you possibly have, invest every penny so that someday you can have a big pile of money in the future. There's balance and harmony to enjoy the journey, but it does need to be intentional and set aside. So a couple of fundamentals that I'll share just as you look at investing. One of them is just my general rules of thumb. The stock market, on average, since it was created, has returned on average around 13%. And so sometimes you'll have people come to you maybe with a private investment and say, hey, nobody else knows about this. Can you go ahead and invest in it? It's been making me 30% for the last 18 months. Typically when you hear that go off for a long sustained period of time, I start to use some caution and make sure you're doing your due diligence and asking more questions. Seek qualified counsel from financial advisors. I think this is critically important. So an advisor can help you create a plan. If you ask that question of how much money do you need, let's say that you're currently making $80,000 a year, and that's what in your lifestyle is comfortable, and you're looking at saying, hey, that would work for me. Well, how much do you need to have in net worth that we talked about in one of the other video segments to create the $80,000 a year in income? Well, they can help you create a roadmap depending on how old you are, how much money you need to be putting aside. Create some tools that will help you earn some interest to get there, and complement that as you go along. But having a plan gives you confidence. And so having someone there to help you create that plan is extremely helpful. So a couple of things that I would throw out on seeking qualified financial advisors is find people that are busy. That sounds crazy, but sometimes the first person to call you back, they don't have anything going on. They don't have clients. When I talk about people that are busy and experienced, they have practiced on a lot more people. Having a lot of time in an industry allows you to go through these types of cycles. A financial advisor that's had to counsel people through a financial downturn has a different perspective on the products that they're sustainably recommending. Some of them work really, really well in almost every type of market, others don't. And so be very wise in interviewing those people. Look at their education. Education makes a difference. Ask them about their education, verify their credentials, listen to what they recommend, and make sure you understand. It's important when you're looking at making financial decisions that you understand it. A great financial advisor is a great teacher. They shouldn't make you feel stupid if you're asking questions and not understanding. And they're just telling you should just do this. Just trust me. You need to understand this. This is your money. And so one of the other principles that I like to ask often as I have financial advisors recommend things to me is the simple question, do you own this product yourself? Why or why not? If you've got someone that's helping you buy an investment property, for example, perhaps a real estate agent or a mortgage banker, ask them if they actually have those types of products and services themselves. Why or why not? It will bring a different perspective if they actually have the product and seen that perform over time. And so hopefully those are some principles. One of the main points and why I believe that a financial advisor is needed is this principle here. And I describe it with this simple graph. We've had studies done for years on this. And so in investing, especially here in Utah, we tend to be a little bit more of a maverick state where we look and say, I can do it myself. I don't need a financial advisor. It's easy. You buy low and you sell high. That's the answer. Well, is what that really means, and so why I need a financial advisor myself, I look at it, my background's in investment banking, in my undergraduate degree, I've got degrees in economics. I'm very comfortable understanding what's going on in the financial markets and evaluating a company. And I'm just gonna share that as a note because I have a financial advisor. And this is why, is what this means. So if I'm buying a stock and I say, hey, there's a company that's undervalued, is what it really means is I'm gonna come home and talk to my dear wife, Shayla. And I say, honey, I found this stock today. And she's gonna say, tell me about it. Well, here's what's going on. Everybody thinks it's gonna go to zero. It's down here. But you know what? Everybody else thinks it's gonna go bankrupt or to zero, but really I think that actually there's a new product coming on, there's a new manager, some different changes in the economy, and I think it's gonna recover and come back really well. That's what it means to buy low. I never do it when it's my own personal money because I'm afraid that everybody else is right and what's going on with the emotions of the market. So I buy it right here after it's gone back up. But I lose that return because my emotions don't allow me to make an educated decision. And I want to point out that is those that actually know what they're doing. Up here, that means I have to sell it when everybody else wants it. You know, one principle that I've heard and loved is a simple principle. The time to get out of investment is when your skeptical neighbor gets in. And that's what happens. A lot of people just all of a sudden get excited about a certain sector in the market. And everybody's getting into it. It's been returning, 18, 20% for the last year. And everybody's looking at it saying, hey, this is what I want to get into. And so that's when you have to sell it. But you never do because you're saying, well, what if it brings me another 18% this year? And so you don't. And you sell it right there. And so you lose that return. So the studies show that actually those that understand how to invest due to their own emotions make on average about a 4.2% return. Those that don't understand what's going on have created this adage that I am confused by, and that is that don't invest money that you don't have to lose. Why is it that you always have to lose money? I believe that's come from those that have tried to make a go of it on their own for so many years. And I had a client call me a couple years ago. I referred him to a financial advisor, and he called me and said, Brett, I don't understand. This financial advisor called me, and he just encouraged me to buy a high-risk, low-return mutual fund, but I found this one over here that's been returning 28% for the last 3 years. That's the one I want to buy. Emotionally, that feels good, right? But in essence, what the financial advisor was looking at, they had done their homework, they'd done their studied up on it, and they saw that there was a mutual fund that was down in the low, and that's when they were recommending for this particular client to get into it. Now it's still up to that client to make that decision because a financial advisor is really there to make suggestions, and your job is to make decisions. So take the time, it's your money. It's important to learn as much as you can, but one of the great purposes of having a qualified, licensed financial advisor is to gain perspective, wisdom, and they're seeing a lot of other people's situations and gleaning best practices that will help you get to where you want to go faster. Next concept is have a process and diversify. So general advice that I like to give out and that the brethren sent out in the letter, the First President sent out in the letter last April is use reputable firms. Look for investment grade investments. So as you're looking at mutual funds, most people don't have any business being in individual stocks and trying to time the market and call that type of stuff. I remember, as I mentioned, part of my background was in investment banking in my undergraduate. When I remember getting out of college, I was day trading, and I knew the fundamentals, was going through it and doing pretty well. I had a little cardboard table with my compact computer on it, and I was doing pretty well grinding out. I remember getting up in my 2-bedroom apartment in Pocatello, Idaho, and walking in there and looking at that. I started to trade for the day. I thought, really, Brett? As I looked around at my wonderful office, you're going to be the best money managers in the world. I thought, get over yourself. And so from then on, I've used great qualified financial advisors, these and mutual fund managers. When that mutual fund manager wants to buy a stock, they call the CEO. And they can actually get great insight and intel. They have wonderful analysts that are all behind them, pushing, getting them qualified data. And so I'm an advocate of using qualified financial advisors and investment grade mutual funds. You can hold the hard asset or get into some mutual funds versus liquidity. So for example, you could buy gold, and you can have your bag of gold, or you could buy into a precious metal mutual fund, for example. Both returns should be about the same, but when you need to sell your bag of gold, you've got to find a buyer and you've got to negotiate and bargain for that price. Where if you're in the mutual fund, you can actually strike that and move it really quick if you had to. And so there typically is a little bit more liquidity there, but you can buy the hard asset. If that's something that resonates well with you, then go for it. Something that Warren Buffett teaches is invest in things that you understand. And so that's one of those principles I would consider is how liquid is it if I needed that capital? Can it provide me a dividend? If I have a bag of gold, is it really sending money to my pocket every month when I need it? And so just some considerations to look at. The important part here, another one is to be steady and consistent. Part of this principle, I would encourage at least 10% of your income going to your long-term retirement. If you're a little behind schedule, that may need to be 15%, but this is a budgeted item. It comes out before play. That 10% has to go in there. Once again, it is a law of the harvest principle. If we do not sow anything, we are not going to reap the harvest. And so, people often get discouraged and say, well, I don't make enough. I have been so inspired as I've had the chance to meet down with so many people. I had a couple in my office a couple of weeks ago that they were making $35,000 a year, and they paid their house off, and they had a fully funded retirement plan. I just wanted to stand up and hug them and clap. That they understood things so well, they had their budget so dialed in, and they were telling their money where to go, and they had made sacrifices, and they now have complete financial freedom. That was amazing to me. So you can do this if you have a plan and a strategy. Putting 10% of your income away, if you're making $60,000 a year, and you have put 10% of your income away, and invested that over a long period of time, when you get ready to retire, that pile of money will be less than someone that's been making $300,000 a year and putting 10% away. The difference is the person that was making $60,000 all along the way, even though that pile of money isn't as big, it will be adequate for their lifestyle, what they're accustomed to. The $300,000 a year lifestyle is going to be very different. And for them to try and react and come down to a $60,000 a year lifestyle is very painful, and often makes them make a lot of speculative bad investments because they're now trying to make up a lot of lost ground, and they find themselves trapped. Once again, doing the hardest things first will always turn out to be the easiest, and doing the easiest things now, just ignoring the 10% that needs to go in there, will always turn out to be the hardest. So I find it's important to be steady and constant and consistent as you look at things. So I'm going to show you an example. This is, by the way, I'm not a licensed financial advisor, and this isn't just a stamp that this is what you should do. This is talking to a financial advisor, find out what the right plan and allocations are for you. But this is an example of a plan. Let's say that I had $100,000 to invest in my 401k or in net worth. Well, you may look at it and say, okay, I want 25% going into real estate, or $25,000. Perhaps you take that $25,000 and put it into a REIT. That's a real estate investment trust. It's a mutual fund for real estate. Perhaps you put that $25,000 as a down payment on an investment property, and yeah, that is an income producing asset. Let's say you have 25% going towards commodities. That's gold, silver, precious metals, oil and gas, agricultural-based industries. So once again, you could go in and buy the hard asset, or you could buy mutual funds. So for example, let's say you were doing mutual funds. You may, out of the $25,000, you may take $5,000 and put it in a precious metals mutual fund. You may take $5,000 and put that into a natural gas mutual fund. You may take $5,000 and put it into an oil exploration type fund, another $5,000 into like an agricultural based fund. You get the idea. And so you can even diversify within those types of things. And then 50% in stocks and bonds. Depending on your age, your financial advisor can help you determine what that right allocation is. The principle here is that it's a process, and you're not wondering. One of the dangerous parts of the market is that people are always trying to pick and say, people ask me all the time, Brett, what should I buy right now, or when should I buy? Well, the point is, when you look at this, it's a process. It's going in. Once a dollar is put into the economy, I'll use this as an example. This is one that I like. If a dollar is put in the economy, it's in this pie somewhere. Well, if the stock market is suffering and going down, typically the money will flow to this side of the equation, and typically the commodities and real estate will do a lot better. And when the market takes off, money will flow back over to this side. For me, it's a hedge and a process, if that makes sense. But these allocations are something that I'm comfortable with. I understand stocks and bonds. Once again, invest in things you understand, get with your financial advisor, and create a plan and a strategy. And then I would encourage you to stick to it and not speculate, be constantly guessing. When should I get into the market? You know, speaking right now of the massive market downturn in the due to the COVID-19. The biggest driver in determining a stock's valuation is earnings. Well, right now, there's no way knowing how long that this economic downturn is going to go to determine what those earnings are. Jim Cramer, he's a host of Mad Money, said something a couple weeks ago that I really liked. He had some callers call in and say, Jim, when should I buy this stock? Or he was asking him another question, when should I lock my interest rate in on a mortgage that I'm looking at? And with the lack of ability to know how long unemployment's going to go and how deep this downturn will go on the earnings component, he answered it perfectly. He said there are two people that know. First is God, so you can talk to him. But the second are liars. And so that's where, when you're speculating and guessing right now of should I go in and buy now? Now's the low, right? It's a very dangerous time, especially if you haven't been in the markets before. This is not a time to jump in. To me, it's gambling. And so follow a process. If you've got it, just keep going to it. If you know that for your net worth calculation, you need to be putting $700 a month into your retirement plan, the $700 goes in. And it goes in, and some sectors are going to be doing worse than others, and others are going to be doing really well. But as you go through that, at least annually rebalance. So one of your sectors will do really well in this calculation, or in this pie during the year, and be way up. So at least annually, if not quarterly, sell what you've gained. You'll be able to buy that which is low, and over time, it's a process you can follow. You don't have to panic and wonder, when should I get into a market and make poor decisions? So I encourage you to find a process and a pattern. Once again, use a licensed financial advisor, and that will help you. Tax bucket diversification. A lot of people are, look at it and say, oh, all my money in tax deferred, such as a Roth IRA or a Roth 401k, rather than a traditional IRA or traditional 401k, or even a non-tax sheltered. One thing to consider in the tax diversification, we don't know when you're ready to retire what the tax code will look at. Like, that's the reality. And so perhaps talk to your advisor. Perhaps you want some money going into all those different sectors. So when you get to retirement, if tax brackets are way up, perhaps you start drawing on your Roth. If they're way down, perhaps you start taking from your traditional. In term, what if you have kids that need to go to college beforehand? There's plans that you can use to help with that, or other expenses that come up. Do you have some that aren't, you're going to be penalized and feel like you can't get to if because they're just under tax sheltering? So consider that and talk to your financial advisor as you use that, what appropriate tax diversification is, because once again, we don't know what the future holds. Another one I throw out there is business owner diversification. I talk to a lot of business owners, and they don't put anything into the markets or into other type of income producing assets. It's all coming from their business, and they say that their net worth is tied up in their business. Look at this type of a time. Perhaps there's a lot of businesses right now that are being struck that seemed almost economic recession proof, and all of a sudden overnight their entire net worth and business is gone. It's important to diversify and have different sectors to put money into. So I encourage you to look at that. And then avoid, as I mentioned, avoid the speculative investing, especially ones that you don't understand. So if you have your neighbor trying to convince you that it's a great time to get into an investment, and they figured out the golden way that nobody else has figured out, I always bring myself back when I'm given that. Really, Brett, there's something that you know that these brilliant minds on Wall Street don't. And so I ask myself those questions. So avoid those speculations. Insurance. As we look at the quotes from the prophets, I started early on in the first segment with that, about studying the words of the prophets. As members of the church, we often look at it and say, is all the prophets teach us is to get out of debt and stay out of debt. Well, that's simply not true. They have taught us to do that. They've also taught us to have an emergency fund, to invest and have money for a long-term retirement so we can serve and live a fulfilled life and not be and be able to give service. But they also encourage us to have adequate insurance. You'll find that in the quotes from the prophets. And so consider this: if you don't have disability insurance or property and casualty, health, and life, talk to to great financial advisors that can help you assess the risk and get the appropriate amount that's needed to help insure you against catastrophic events that could wipe out your entire net worth. So one thing that I would encourage when you're looking at life, or it's not just life insurance, at any of these types of insurances, read what you purchase. This is so critical. Almost every insurance policy I have ever taken out is I have read it, and ask the insurance agent, well, this isn't covered, this isn't covered, this isn't covered, but you told me it was covered. They'll say, well, what do you mean? They'll go look at it and they just sell the policy all day long and don't get into the fine print. That insurance is critical. When you need it to work for you. It's one of those that you'll become educated in understanding your benefits. Take the time to ask in any one of these categories, whether it's health insurance, life insurance, your property casualty, and disability, what is in that policy. Make sure you understand it because you're going to pay a lot of money. Hopefully you never have to use any of them is the goal. But when you do need to use them, make sure there's not a loophole in there that you weren't aware of, and that you've got adequate insurance for what you were intending, and you paid and got what you were expecting to get out of it. So I would encourage you to read what you buy. And then identifying Ponzi schemes and risky investment. You'll notice in the first presidency letter we started with that they encouraged us to be considerate of that they were concerned by the rise of people, even people in positions of trust, purporting that they had something figured out. So I just throw out some points and tips after 20 years of going through the financial markets and seeing people taken advantage of from Ponzi schemes. The most common places you'll see is around real estate, private oil and gas, precious metals, and cryptocurrency. Why? Because they're hard to find a valuation on. For example, if you're buying the price of, or buying into an oil well, how do you determine what the right price is? How much does it really cost to drill the well? They may come in with their numbers and just present it to you, and it's hard to get the valuation on what's going on there. Real estate, have you ever considered with real estate the ability for someone to be able to maneuver the number? Many people look at real estate is less risky than the markets, for example. Well, that is true over time, but if you look at it, what if every day you came home and on your garage, similar to a stock ticker, was how much your property value went up or down? How would that affect your risk assessment on that? And so understand the risks associated with each investment. Precious metals. This is one that's very difficult. You've got to find private buyers if you're buying the hard asset once again, and a lot of Ponzi schemes are created from that just because the inability to create transparency and a lot of non-regulation. So cryptocurrency, once again, it's new. It's all over the board, so a lot of people very speculative all over the place. So a couple of things that I would throw out as principles on that. I'm going to pick on oil. Actually, I'll use precious metals as an example. Let's say that I had someone that said, hey, I figured out that there's a special way to buy gold or silver, and no one else knows about it. I come back to this principle. This is where bells go off in the back of my mind saying, wait a minute, there's this precious metals mutual fund manager that manages billions of dollars worth of assets in this area, and they're not aware of this special thing that's been figured out. They've got analysts that are looking for every angle to be able to provide return because they are paid off of the value of that fund going up. They're equally yoked. I have to sit there, but they're also regulated, and they'll go to jail if they do illegal things. So I start to look at that and ask myself, well, if they're telling me that they can return 30% per year over an extended period of time, that's where I'll start to look at it and give you an example. Go out and benchmark it against a similar mutual fund. So for example, here's one. This is a Fidelity Select Gold portfolio. You'll notice here that year to date was up 6.75. This was as a few months ago. It's actually about a year ago. The 1 year return was 1.54, 3.5 over 3 years, 5 years at 2, and then the 10-year of negative 2.77. So I have to ask myself, if someone has privately figured out how to beat this mutual fund that's in gold over that extended period of time, I have to wonder what's going on. And when you see the high returns coming, typically it's coming from other people pooling their funds together and going over time. Now, people of trust can even document this. Share just an experience, for example. Let's say that you have somebody come to you on a piece of real estate as an example, and let's say that they purchased it for $225,000. They found a seller that had to get out of state, for example, and they were trying to close on another home. Their home was really worth $300,000. Let's use that as an example. And so you were able to buy it for $225,000. And you turn around and you sell it 2 or 3 months later for $300,000. Well, if you do the return on that, well, that's going to be over 30%. And can you document it? The answer is yes. So what if you have a real estate agent coming to you saying, hey, I help my clients get a 30% return all the time? Well, that happened on one instance. Well, they, as an insider in the business, may be able to find 1, 2, 3 of those outliers a year. But what if that same agent was given $5 million and told to do that month in and month out and provide a 30% return? All of a sudden, their ability to find those outliers in the market go away because of all that cash that comes in. And that's typically what happens in a Ponzi scheme, is those returns are coming because other people are pulling their funds together, and then they're using those funds to write out the checks to show returns to try and build up the size of that scheme and be siphoning off income to try and get away with it. And so hopefully that helps just on explaining some of that on inflated returns. So I am grateful for the opportunity that we have to learn. One of your greatest assets is your own mind. We live in a day where you can get a lot of transparent information and knowledge. Educate yourself. This is an important part of your financial well-being, which leads to your spiritual well-being and your ability to serve. And so I believe it's worth investing the time, taking the energy, hire licensed, credible financial advisors and credible institutions as you look at that. Always remember it's your money. Never feel stupid. And then involve the Lord, pray, and you'll be just fine. So I hope this was helpful for you.